Hello, hello. So today we're talking to a lot of retirees or people who are looking ahead to retirement. And we're going to talk about some tricky, let's call it a retirement tax maze. And we want to touch on IRMAAs, RMDs, and Roths. And if any of those acronyms or words are confusing, then just hang tight because we're going to talk a little bit about them.
I mean, you talk about a joy killer. Go into a conversation, say, "Can I talk about IRMAAs and RMDs and Roths with you?" They go like, "Who are you?" And I want to get away from you, like right now.
Talk about a buzzkill. Yeah, definitely don't show up on Friday night or your next cocktail party and say, "Hey, you know what we should talk about is IRMAAs," right?
Well, even saying IRMAA, right? There's some people who know exactly what that is. There's others who say, "What?"
Very few people know what that is.
Yeah.
And let's break it down.
Right.
IRMAA stands for Income-Related Monthly Adjustment Amount. But what does this apply to? What are we talking about?
Even after you explain what the word means, it still is boring. It's like,
That's right.
I know, income-related monthly
people,
adjustment amount. We're talking about Medicare. That's what we're talking about.
When it hits people, it's not boring. It becomes a huge focus. So when you enter into retirement, you start paying your Medicare. Often the premiums you have for Part B and Part D are taken out of your Social Security, very normal process. However, if you have other income, if you're making money while you're in retirement, retirement being just past 65, if you're of retirement age and you're making money and you pass this IRMAA threshold, all of a sudden your Part B and your Part D of Medicare get exceedingly more expensive. And we've had clients say, what is going on? Why am I paying so much? My wife, we don't remember paying this much, but now we're angry at each other because we're paying this amount.
And I think the part that's tricky, in fact, they call it the stealth Medicare surcharge, is because it applies to your modified adjusted gross income. So we're talking about your tax return from 2 years prior. So you might not actually see the application of the surcharge for 2 years, right?
And also the reverse. So if you do fix it, it takes a while for it to get fixed. So you may have a year or more of higher Medicare charges. So the government works very slowly in that area.
Yeah.
Anyway.
And the reason this becomes a big deal for people who are over 65 is some people are just working. They have a job, they haven't retired yet. They're on, they signed up for Medicare and they're just making too much money. So they have these surcharges. The other time, and what we'll talk more about, is when people get to these ages, they start taking the required minimum distributions. They're taking money out of their retirement accounts, either now that they're old enough, then they're in their 70s, or they just need the money. So they're taking it out. And also Social Security is coming out. And so they have these income streams that they may not have a whole lot of control over, and they're pushing them into these higher brackets unintentionally. Mm-hmm. So that's kind of where we find a number of our clients. It is primarily, I would say, the people who are still working are the most aware of this, but people at all ages, working or not, can get hit with this. And it's not a massive amount in the sense of the biggest dollar figure, but it's a very painful adjustment that people aren't expecting, and it surprises them.
This is why
they're paying too much.
Retirement income planning can be so complex because as you're working and you're anticipating retirement, you're putting away, and you're just hoping you're going to have enough, right, resources available to you when you step into retirement. What a lot of people don't realize is that when RMDs start to kick in, they're forced to take income into their household. And then you've got these additional income streams like Social Security, or there might be a pension, or there can be a variety of different income streams. And some of that, if you don't have some advanced planning in place, it's just, you really are kind of a sitting duck, right? The tax burden can be greater in retirement than during your working years.
Yeah. So, and again, not to use all this our jargon, but QCDs, which stand for Qualified Charitable.
Another acronym. Ding, ding, ding.
Right.
Mm-hmm.
But you're limited at age 70. You can't do it. And so, the government makes it confusing. So RMDs for some people start at 73 now, not 70 as it was in past times. And it's also 75 based upon when your date of birth was. So if you're born before 1960, you have to start taking money out at 73. If you're born after 1960, then starts at 75. But these QCDs come into play at age 70, which is really weird. So that's when you can use you can use money out of your retirement account to go into these charitable deductions, but it also has an impact upon how your taxes charge. It's all that front page, that very first page of your tax return. It's all right there, but most people just gloss over. They don't have a clue what all that stuff means. So, but again, you got these different dates, different amounts, different timelines. And it is confusing. It is very
and
confusing.
Different rules. Was it 70? Was it 73? Right nowadays, we don't talk about RMDs at 70 anymore because the rules have been updated. But we do have some clients born 1960 or prior. They get their RMDs at 73. 1961 or later, we're talking about age 75. And then you've got these QCDs. Now, that's a charitable deduction, right? So we're talking about bringing down your income into the household to maybe help avoid some of these IRMAA markers. It's a graduated, there's like a whole table, and it's discoverable online if you just go and look at the current IRMAA. I think they call it the IRMAA GI income table or something like that.
We have software that overlays so we can see where your IRMAA, where you're going to pay more in Medicare if your income is above a certain level, right? I mean, and if you're single versus if you're married, it all has. So if you're a widow, and maybe the previous year you filed jointly with your husband, he's now passed away. So now, but all your income flow still comes into you, right? So, I mean, it all becomes it's more complex than you realize, I guess what I'm saying.
And I think for a lot of these, because we was talking about a few ages and numbers, you have 65, 70, 73, 75, like we just talked about all those items. Some of this is just the opportunities of what you could do. And we talk a lot with clients, the sooner we're doing planning, the sooner we have a vision of what's ahead, the sooner you can make good choices and make some changes. And if you get surprised by these items, like you said, Randy, because there's a 2-year lag on how they review this, you may get hit with it and then be stuck with it for a couple of years. And so as people are approaching these ages, it's not like there's one specific age, but as they're approaching, 65 plus, there's just some different items that if they've never thought about it or talked about it, that it's really important to start thinking about and talking about and planning for. And for some clients, we look through, like you said, Randy, that first page of their taxes and realize these are not topics they need to worry about. They're not going to be in this space. There's others that their income is way past all this and they're going to suffer these higher rates. But really, it's that middle group. And there's a lot of people in that group that say, hey, there's some opportunity for you to make some adjustments now, and it's going to allow you to save some money as you enter into retirement. And I think, Laura, you said the comment, it's surprising for a number of folks when they feel that they're entering into retirement and all of a sudden they're experiencing more taxes than they felt they did when they were working. And it just doesn't feel right. It feels like I must be doing something wrong. And maybe there's some opportunities that could be had to tune things up, and maybe it's just the level of income that they've shifted into their retirement years.
Yeah, we have a lot of clients, especially new clients. In fact, I think there was one yesterday we were talking about, and they say, do you do tax planning? And we always have to kind of bifurcate the conversation because we say, well, we don't do tax preparation in our office. We don't have a CPA here that does the tax preparation. They probably, more than likely, have a CPA that they work with. But we do tax planning, right? And so we look at it from a strategic perspective of how are we minimizing tax liability over time, not just in this 1 year. Right. That is true. And there are some strategies to doing that. But right, looking ahead over the lifetime of the client and saying, what can we strategize to help minimize your tax liability over time? So
good. Yeah.
Or avoid tax increases like IRMAA.
We threw around the word RMD. That was the other part. We talked about IRMAA. That's that basically surcharge on your Medicare.
That was the second acronym.
Yeah. And the
Modified
QCDs,
Adjusted Gross Income. That was the third one.
The QCDs fit right in with the RMDs. The RMDs are required minimum distributions. And this is anything that was put into a 401k or an IRA or some sort of a qualified investment account while you were working. Now that the government has allowed you to let those funds grow and not have any taxes on there. Now these required minimum distributions, saying there's a required amount that you have to take out at these certain ages and bring into your household. And the whole point of that is it's going to trigger your taxes.
Yeah. And an easy way to think about this, just for our listeners, if you paid taxes on it ahead of time, you put it into an after-tax account, and there's going to be investment growth on that. If you didn't pay taxes on it and you put it into an account, these are the accounts that are called qualified or for the purposes of retirement. And so the government says, yeah, we'll let those grow until a future date, 59 and a half, we'll let you start taking money out, right, without penalty, or we're going to force you to start taking money out at a certain age 73 or 75, because eventually the government wants you to pay taxes on that money. They've allowed you the benefit of letting that money grow without having to pay taxes on it. And now they do want you to start paying taxes.
Yeah. And so as people move into these, some people are well aware of that. They know exactly what it's going to be. That's the income they're planning on. Others, they kind of get surprised by looking at what the amount is and how much they're going to have to take out. We've there's only a few clients we've had to deal with this with. There's a number who have overfunded their retirement accounts.
Right.
They've put so much money into their retirement accounts during their working years and kind of live so frugally that as they get into their retirement years, they actually have this overwhelming amount of income that they're being taxed on. And yes, they got to delay the taxes, which is great, but they actually get pushed in these higher and higher tax brackets that was unexpected at the time. And with some planning, they could have evened out their lifetime kind of tax bracket creep. It's just an opportunity for a lot of folks to do a little better with their tax tune-up. But it's a part of almost everyone's retirement plan is there's some sort of RMD requirement that's going to impact their household.
Yeah, and I think that we run across people that have almost like 3 careers. People that went in, let's say, in the military, and they work until they're like 20 years in the military, but they can actually get a retirement in their 40s. Then they get another job, and they get another 4K, another pension, and Social Security benefits. And then when they reach into retirement, all of a sudden they've got all this income that flows to them, and they can't do anything to slow it down. Now, this is a key point on the QCD, which is the qualified charitable contributions to it. You want to make sure that people are charitable. If a client, if you're listening to us and you're just not, you say, no, I'm not going to give to church. I'm not going to give to schools. I'm not going to give to medicine. I'm not going to give. So, and I guess the attitude is it part of your nature to be charitable with your money?
Right.
And it's probably good to have that conversation as early on as you possibly can.
Yeah.
And you want to show to clients how that benefits them more than just altruistic aspects of giving. But it is really important for people to understand that that's part of the income and the tax code is how can you give to reduce. We didn't get into donor advised funds, but I mean, there's a bunch of other stuff that we can do to help reduce taxes. But you have to have a nature part of you that wants to give, right?
Yeah. And I think that I want to tease out too, like, are you charitably minded? We still have clients who are extremely generous, meaning how they like to give their money away. Maybe they like to benefit other family members. But when we're talking about charitable donations and the tax benefit associated with that, we're talking about a federally registered charitable organization. So 501c3 or 501c6, right? That's the IRS code that it's referencing. So it has to be a federally registered charity in order for you to receive this benefit. You may be extremely generous, but maybe the place where you like to share your funds is not with a qualified charity. So
yeah.
And the other question, I think, going back to what you were saying, Jeremiah, is, if I was an individual listening and maybe kind of concerned or asking myself that question, did I overfund my retirement, right? How would they know? How would you know? And what would you do, right? If you've overfunded you're getting close to it, right?
Yeah. Well, the first concern for most people is not running out of money. And a good way to avoid running out of money is to put as much as they can into their retirement. Most people, rule of thumb would say, hey, if you're getting 10, maybe even 15% of your income is going to retirement, like during your working years, that should build up a sufficient fund for you to enjoy in the future. And for most people, they're on not getting in enough. Like that's the most common thing is they're trying to push to get more. Get into their 50s, they're trying to do these catch-up contributions to get enough in there. But really, I don't think most people know if they have enough or too much. Retirement just feels like this black box. And that's a big piece of when we do the planning to kind of map out to say, how's your income going to change when you enter into retirement? What assets do you have? What will they provide to you on a regular basis? And is that enough? And with the planning, like I said, it's not as common, but it definitely happens where people are being very aggressive and they've been very consistent getting the money in there. And we realize at some point, you don't need to contribute. In fact, if you do, you're really just making your future taxes much higher. So to answer your question, Laura, I think the only way to really know is to have a full plan. And the hard part with full planning is we see so many people that come in with the back of a napkin, hey, here's my expenses, here's my income, I think.
Yeah.
And as we look at that, we say, well, do we consider Social Security? Oh, yeah, I got to put that in there. Do you have a pension? Well, I did teach for a couple of years. I do have a small pension. We start lining out their retirement income, and it's meaningfully more than what they thought. And so what went from a concerning, I'm not going to make it, realizing, I'm going to have ample in retirement. One, that's a really good moment, right? To be able to walk through it with people. But two, to really know if you have the right amount in your retirement is a little bit of a tricky calculation. And what I don't think is a great service is a lot of things online you can put in, what's my number? Like, what do I need to get to? I need to get to 1 million or 2 million or 4 million, whatever that number is. And it's different for everybody. And those types of software, those easy, quick calculators, they make so many assumptions. investments, needs, all sorts of things. And you can adjust those. But we find there's so many variables that require, kind of year by year planning and not just a, back of the envelope number that you're targeting.
Yeah. And speaking of back of the envelope, I typically tell clients if they're wondering how much an RMD is, a really simple calculation is you take the balance of all your retirement accounts. If you have more than one, remember they're in the name of the individual, not jointly. And so the individual, you have to take the cumulative of the retirement assets as of December 31st, the year prior to when the RMD is due. And it's roughly about 4%.
Right.
There is, in fact, a very detailed table that they apply for the actual amount, or in our office, we do that work for our clients and help process that for them. And there's certain dates by which you have to take those out. So again, a lot of rules around that, but something that applies to most people.
Yeah. So we jump into it.
Yeah, go ahead. So let's say I've accumulated all this money, but I want to reduce my taxes. So the whole aspect is Roth. What do I do?
Yeah. What do I do? I think that's a great question. What do I do? And we mentioned one, qualified charitable distributions. If you are charitably minded and you're getting close to these ages, you can decide, hey, instead of receiving my RMD, I'm going to designate it directly to a charity. And what that does is it allows that income to stay out of your adjusted gross income, your AGI. It keeps that income off your taxes and lets it go directly to the charity, keeps your AGI lower, allows you to qualify and not have these surcharges. That's one version. The second version takes a little bit of more planning, and this is probably one of our favorites, but it's a Roth conversion. It's where you take some of your money earlier in your life and you convert it from being in this qualified account that's pre-tax. You pay the taxes on purpose, the amount that's useful, and you convert it to a Roth, which means in the future, a Roth qualified account will not have any taxes when it comes out. So it will not impact your IRMAA. It will not impact those things in the future. And not for everybody, for a lot of people though, if their income is rising and rising as they're working, and then they retire and it falls down very low. They have a number of years before they hit 73 or 75. So those middle years between retirement and age 73 or 75, man, those are great opportunities for a lot of people to do some conversions and not push themselves in the high tax brackets, but just the medium tax brackets. Maybe the 22% is enough to be able to be strategic for their future and bring down what was a high future value, bring it down, those RMDs in the future, bring them down to what's a little bit reasonable. And it's strategic tax, right? It's not avoiding the tax. It's just being strategic of when and how you take it.
So I think about it like a teeter-totter, right? And as you step into retirement, if your side of the teeter-totter goes down because you have lower taxes, you have less income coming into the home. Now, you might have interest in dividends, but we're talking about ordinary income. So that's what tax rate we're looking at, right? And so if that reduces for a certain amount of years before RMDs kick in, what you can choose to do post age 59 and a half, remember, because you don't want to be penalized for it, is you can purpose to take withdrawals from your retirement accounts. You'll have to pay taxes at ordinary income tax rates, but at a lower level, convert those into a Roth. So you reinvest them. And in the future, those earnings from that Roth account, as long as you let it sit for 5 years, right, will come out tax-free. It's also a great kind of legacy or inheritance model. If you're planning to designate some of those funds to the next generation, it can be a good tool for that. So, and then your teeter-totter starts to balance out rather than have it be so high. Once those RMDs start to kick in, you're actually going to start to balance it out. So you start to bring down some of this tax liability in the future, and you're just converting it into another investment tool. It doesn't mean that you don't still have access to those Roth funds throughout the duration of your life, but number one, you're not going to be forced to take them out at a certain time. And two, when you do take them out in the future, it's all going to be tax-free.
Yep. And again, I think the software that we work with, I've seen this again and again, Jeremiah, you've gone through it, but it makes that there's a line that shows the different tax brackets. And you want to make sure the Roth conversions, that the taxable amount stays below a certain line item. And it's very visible for the clients to see, oh, if I go above that, I'm going to pay a much higher tax rate on that distribution. Because remember, at the end of the day, to get qualified money into a non-taxable benefit like a Roth, you still have to pay taxes on either the contributions or the distributions into it. So it's the question is how much, right? So Anyway.
Yeah. And that is a question. People say, well, how much should I take out if I'm interested in this Roth conversion? And so we have a software, or your CPA could probably calculate how much more room do I have to fill up my current tax bracket before I spill over into the next tax bracket. So let's say you're at the 24%, right, federal tax bracket, right? How much more room do I have to fill that up before I start spilling over into the 32% tax bracket? So you can actually quantify what number would be ideal to optimize this whole scenario.
That's great. And some tax brackets, like the 22 to the 24% tax brackets for federal, they're not that different, right? It's a little more painful, but not a big deal. But the 34 or the 24 to the 32, that's a big jump. And so we have a lot of clients, when we do this analysis, we'll kind of pick which tax brackets, make sense for them to be willing to fill up for that year. But keeping them out of some of those higher tax brackets, which are a little more painful as you get into them. And this is
while we wrap up, how many acronyms have we gone over now? I wasn't exactly counting, but at least 5, right? At least 5. So we've talked about IRMAAs, we've talked about modified adjusted gross income, we've talked about QCDs, we've talked about RMDs. It's not an acronym, though. I don't believe it's just called a Roth.
Yeah. It's after Senator Roth, I think, it's his last name, I think, who set it up. So anyway.
Mm-hmm.
So let's say nearly 5 acronyms. Those are your takeaways for our listeners. But just to bring it all together as you step into retirement, there are some tricky tax implications. And so as advisors, we don't want to cause fear and trepidation. We want to offer service and support and hope that you can actually strategize your way through these murky waters at time to clear sailing in the future. So do you gentlemen have any other takeaways for our listeners?
I think most people want to just do a one and done. Set it up and it just goes forward. But taxes don't allow us to do that. And events in your life change. And all these things have to be looked at on a continual basis, because it is not a one and done. It's going to be subject to changes. And it's important that you come alongside of an advisor like us that helps you go through that, make sure you understand all these. And tax law changes. We just passed the big, beautiful bill, whatever. But there's a lot of changes in that thing. And you got to understand how that's going to have an impact upon you and how much you pay in taxes.
Yep, that's great.
So until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricoreadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricoreadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.